I believe my thesis, Paul, for 2025 is that we begin to return to what we call reality, which means fundamentals matter again. So can we just talk fundamentals for a second?
Absolutely.
So a gentle reminder for these times when we've just come through, when you invest in stocks because they're going to be worth more money in the future. No, you invest in stocks because stocks represent ownership in a company. And what does that get you? Well, you have some voting rights, but ultimately the value of a stock over time is very simply the cash flows that are returned to investors. This is something Warren Buffett knows well. He buys companies for their cash flows. People forget this. People buy companies with zero earnings, negative earnings, PEs of 200, all of that. And I get it. But I just want to remind everybody that ultimately a stock has a value because you get cash back, right? Like, can you imagine, Paul, buying like, let's make it simple. Can you imagine somebody saying, Chris, I'm buying these bonds because I think they're going to go up in price? Like, no, you buy bonds because they have a yield, right? That's why you buy bonds. We haven't lost sight of that entirely, right?
There's still a lot of trading that's going on, bond price appreciation, but you're right. They call it fixed income for a reason. You're buying the bond for the income that it can generate over a certain period of time.
Well, I see this drives me nuts, Paul. I'm reading the Wall Street Journal and they say Apple returned cash to shareholders in the form of a $2 billion share repurchase. And I'm like, oh, no, they didn't. They went out into the market and bought shares. Returning cash to shareholders is called a dividend. Why didn't they just issue a $2 billion dividend instead of buying shares back? We all know why. It's because they dilute their stock by issuing warrants and options and things to their C-suite people, and then they have to soak those back up, and they call that returning cash to shareholders. I call that executive compensation.
You're right.
Which is the opposite of giving cash to shareholders.
Well, was it Buffett or was it Munger that said, show me the incentive and I'll show you the outcome?
Munger.
It was Charlie Munger, yeah. So show me the incentive, I'll show you the outcome. So how is the C-suite compensated, or the the important employees in most companies, through stock options? And what does buying that stock back instead of distributing those dividends to the investors? But investors haven't demanded that be sent back to them either. So this is something where it seems to be everybody's playing the same game, but that's not the way it should be. Stock buybacks were outlawed prior to 1982, if I remember correctly. So
somewhere in that zone,
early 1980s. But I wish that they were banned, outside of an extreme approval process, so that we could get back to fundamental investing and distribute those profits to the investors and the shareholders through dividends.
Yeah, through dividends. That's what it should be, right? And to be clear, if a stock has a dividend yield of 4%, I'm basically saying I'm willing to wait 25 years to get my cash back from this company.
Mm-hmm. Yeah, that's right.
Right?
It sure is.
So, all right. Beyond that, getting back to this, though. So I'm going to just rip through a few slides here, Paul, and then we'll get to the part of how you deal with all this, because you have the hard job. I just point it all out. You have to deal with it. So here we're looking at the S&P 500, a universe of 500 stocks. This is called a forward price to earnings ratio. So their current price today, what analysts divided by what analysts think their earnings are going to be next year. Okay. And so right now it says that the current level is around, let's call it 23. I know it's just under that, but so that's the current level. And then this is every year the stock market's been open. And so it's asking and answering the question, if the forward PE was, say, 20%, was at 11, what was the total return you would expect for the next 10 years? And if you were here at 11%, it would have been anywhere from a low of about 15% to a high of about 20%, right? Does that make sense? So for any particular, I think you can see there's a very clear trend here, which goes like this. It's not hard, very easy to see. There's a trend which says the more expensive things get, the less 10-year returns you should expect to come off of those. And we're at a current level now, which is associated on average with a 0% 10-year return. Paul, how many of your clients are expecting a 0% 10-year return on their stock portfolio?
Not one of my clients are expecting that, but I have prepared them for it in the testing that we've done to make sure that their plan's resilient enough to stand it. And
Right. And, this is all of history. This is all of history here. So it
yeah,
might be different this time. But you know what? If it was different from time to time, you'd have dots like where my little red dot is every so often. They really pretty consistent, aren't they? They just say that the more expensive a market is, the less you should expect in return. And some of these are actually negative expected returns. We're edging into that territory.
they are. And I just counted those approximately. That's about 15 other times throughout history that we've been in this similar situation before, and it didn't turn out differently because those were actual subsequent returns from that period. So, yeah. And the common theme of where we are is just the euphoria and the excitement and because one of our weaknesses, Rafa Dabelli has a great book called The Art of Thinking Clearly. So it's just short chapters on all of our mental weaknesses. And one is hindsight bias. For whatever reason in our human makeup and our brains, we have a hard time anticipating the next 5 years to be different than the past 5 years. So just that mental bias that we have and that mental weakness we have in our humanity makes it hard for people to imagine that the next 5 years could be anything different than what it's been. And a lot of people are speculators that don't realize that they're speculators, but because they've been rewarded for that speculation through massive government intervention, they believe, hey, I've got this figured out. I'm smart enough. I'm not going to be in trouble. And you've got a whole generation of mutual fund money managers and ETF managers that have replaced the gray hairs that came through 2008, because those who understand the pain of what can happen to individuals historically are handicapped to an extent, because we all recognize this is a dangerous environment. We have to play the game by the rules that are forced upon us, but this is a dangerous environment. And we don't want to be driving down the road 20 miles an hour over the speed limit. We need to be driving the speed limit with our foot very close to that brake to stop and turn if we have to. And we will have to. I just don't know when it'll be.
It will. And I forgot to mention my tagline, which, investing at these levels, Paul, it's not easy. It either requires gray hairs or will result in them.
That's right.
All right. So we see how expensive, from a very long-term perspective, expecting this chart says very clearly for the rational person out there, not emotively driven, not trying to guess what the Fed will or won't do, any of that, says that what you should expect is a 0% return. That would be the betting person's wager in this environment. I'm going to hope for more, but I'm going to plan on 0. And I don't know that many people that are planning on 0. You mentioned euphoria. This is the euphoriometer, which is a combination of forward PE, VIX, bullish sentiment. People have never been quite as euphoric. And by the way, this is heavy duty on the retail side too, which is a whole other story. But as you and I know well, Wall Street needs a bag holder when they decide to pull the plug. And so it always makes sense that you would get a lot of euphoria. The euphoria would climb right before a big fall, as we saw in 2000. Again, 2007 wasn't a giant stock euphoria. That was a different euphoria. But this is crazy. At any rate, we got that. You've mentioned the Buffett indicator a bunch. I just wanted to put so people could see clearly what it is. It's the total value of the U.S. stock market divided by annualized gross domestic product. So if we take this number and that number, divide that by that, we find out the Buffett indicator is at 208%. That goes into that 2.08 times. So this is the Wilshire 5000, which is the total universe. That's all stocks. That's when we say, what is the total U.S. stock market value or capitalization? It's the Wilshire 5000. So the dot-com bubble, that ratio, the Buffett indicator, got to 140%, was just over 100% in 2007, and today it's 208%. So when we say it's different this time, Paul, it is different this time. We've never been here before. But to put money down there and say, I need this to go higher, well, we don't have a lot of history to work from.
No, we don't. And the leverage that's under the surface of the market that's out there right now as well. And one thing I will point out that I believe that euphoria meter is not counting real estate specifically, if I understand that correctly. There was as much euphoria in 2007. It just wasn't in the stock markets. It was in real estate. Because I'll tell you, back in 2007, I remember, or 2006, when I started really warning people that there could be some concerns. 2007, I'm telling people, get out of your bank stocks. This is going to end badly. 2008, I'm really kind of ramped up. Just about anybody that was in real estate was telling me, I'm so sorry you do what you do for a living. Real estate's the place to be. So I think that's where that euphoria was just as much from what I saw in dealing with people in 2007. It just wasn't in the markets. Where we are now, we've got that euphoria in the markets, and there's just as much euphoria in the real estate as well. So what's on the other side of this to help pull us out? 2000, you had a real estate bubble to cover up the damage of the dot-com bust. 2008, the stock market went down dramatically, but it wasn't so overvalued that it was down 80%. Now you've got stock value overvaluation, you've got real estate overvaluation. The bond market is not taking into consideration the reality of what interest rates are telling us yet. And the bond market may be the disciplinary function of the foolish spending of our government, in the next couple of years. Because I wouldn't be surprised to see the 10-year go 75 basis points, 0.75% to 1% higher than where it is right now, sooner rather than later.
Yep. And well said. And let's carry on to continue the it's expensive this time story. So this is the P to S, which is price to sales. So take the total market capitalization of the NASDAQ and then divide it by its sales, not earnings, sales. So we're at now a multiple of about 6.5. Again, never been here before. It's wild. So this is, again, stupid expensive. As in, we don't have a historical analog for how expensive it currently is, right? And we've seen the price to book, right? This is now the most expensive it's ever been, higher than March of 2000, higher than 1929. And if you're going to buy the stock market at this level and say, I think this is just going to keep going, it reminds me of that old movie quote, right? Well, do you feel lucky, punk? Do you?
The problem is, sorry, Chris.
It's just, but this is looking at that price to book, but it just blowing up. So we're just looking at the last part of that curve there, not the whole thing. And here we can see it from 2000 when it hit that peak at just a hair over 5. And now it's at 5.19. But very interestingly, it had a big sort of an aggressive expansion here from the fall of 2023. If we have time, Paul, I want to talk about fall of 2023 and the rescues, but for now, I just finished this whole section up by saying this is looking at that Buffett indicator over time. And this is stock prices here in the blue wiggly line. And in terms of that ratio, now it's standing at 208%, 67% higher than the long-term trend line, right? So if we were going to fall back to that long-term trend line, it would imply a 30% decline in stocks. But if we went back just one standard deviation back to below, that would be a 60% decline. And if we actually overshot, if we went 2 standard deviations to the high and then we went 2 to the low, I don't know, that's 50% off of 200. It'd be about a 75, 80% decline, roughly.